Hello everyone, welcome back to my channel. It's me again, Manny Mine. If you're new to this channel, please subscribe. Just click that subscribe button and your notification bell so you get updated on my next videos. Before we start, I would like to say that I'm not a financial advisor in securities. So this video is made for educational and information purposes only. So sit back and keep watching, hoping you will learn something as we go along. As we already discussed the things to do before direct investing and the basic factors affecting the stock price movements in the stock market, particularly the demand and analysis or the demand and supply relationship to pricing of certain stocks, let us now apply it to one of our investing. So now, let's talk about Ericsson. Ericsson, a Sweden-based company listed in Nasdaq as ERIC. Ericsson is a leading provider for 5G equipment. Let us talk this company, its feasibility, its stock promise, as this company is driven for innovation, technology, and cost leadership. Ericsson, a dividend-paying company yielding 0.77% as of June 5, 2020. It has fair value estimate for 52-week period of $10. Meanwhile, last June 3, 2020, Ericsson shares closed at $9.84 from previous closing of $9.54. An increase of 3.14%, higher than industry's benchmark of S&P 500, which increased to 1.36%, while technology industry has 0.40% only. Now, let's take a look on their fundamental analysis: financial stability, financial liquidity, financial performance, and sales growth. First, let's start with current ratio. It is a measure to company's ability to meet its short-term obligation. Ericsson is considerably fair at $1.32 in 2019 compared to industry's benchmark, in which Qualcomm and Nokia, Ericsson's direct competitor as communication service provider, have $1.88 and $1.39 respectively. Cash ratio is quite a red flag on my point of view, as Ericsson had 0.44 in 2019 and 0.42 in first quarter of 2020, which is relatively low against Qualcomm's $1.37 and Cisco's $1.05. One of Ericsson's strong financial indicator is its debt-to-equity ratio. It has $2.44. It might sound alarming, as the ideal ratio must be around 1 to 1.5. The industry where it operates has larger debt-to-equity ratio, say Qualcomm, which having 5.71. Debt-to-equity ratio compares the company's total liabilities to its shareholder equity, which can be used how effective the company is using its financial leverage. As too much dependent on debt shall give each company higher risk to bankruptcy. Therefore, a higher debt-to-equity ratio would mean a higher risk to shareholders upon owning that stock of particular company. Ericsson at the first quarter of 2020 is having 79.5 billion SEK and a net cash of 38.4 billion, with only 8.7 billion debt to mature in the fourth quarter of 2020. They also have an undrawn credit facility of 250 million euros, and they also have an average maturity of long-term borrowings of 2.4 years. Having a free cash flow of 2.3 billion SEK in the first quarter of 2020 solidifies their investment towards research, technology leadership, at the same time, an opportunity to drive efficiency and cost reduction to increase their competitiveness. Working capital impact of negative 0.4 billion SEK, they are able to reduce trade payables and somewhat higher inventories which offset by lower trade receivables. Now let's talk about Ericsson's profitability, how it's able to manage its financial performance. In 2019, Ericsson had increased its sales growth at 7.77% compared to 2018 of 2.66%. Gross profit margin in 2019 is 37.47%. In first quarter of 2020, it became 40.4%, which is a significant increase for this type of company operating in a very competitive industry. Increasing its gross profit margin in the first quarter of 2020 is a good indication that Ericsson is progressing towards its contract negotiation and had earned significant cost leverage. Having positive sales growth at the midst of pandemic and positive net margin shows that the company is gearing towards the right direction, though EPS growth has been impacted by COVID-19. Their net margin at 0.98% in 2019 for me is fair enough for this kind of company, which actually emphasis on research and development, which is good for shareholders in the long run. Investing on research and development just means that the company is preparing for another breakthrough, always finding a new era of opportunity and investment to future technology, which is now 5G and the incoming AI market, as well as the Internet of Things. In last quarter of 2020, they have at least 9 billion being budgeted to R&D expenses. The increase mainly in networks, lower effect from capitalized and amortized development expenses in digital services, and investment in 5G and artificial intelligence across all segments. What about its management effectiveness? Let us measure them as to total liabilities over total assets, return on average assets, and the asset total growth. Total liabilities over total assets of Ericsson in 2019 is 70.9%. At first, I feel scared on it. It means that they have a lot of liabilities compared to their assets. However, comparing it to the industry, Qualcomm has 85% while Cisco has 66%. So it means that the liability of Ericsson is fair enough, considerably be in between with its competitor. Meanwhile, management is doing good in managing the company's assets with 2.26% growth in 2019, while Qualcomm has only 1%, and Cisco is negative 10%. Why? Each company has to invest further on their assets because asset will give each company a future revenue generation. And for me, we have to be future oriented. This comparison shows that Ericsson's management team is doing the right thing in managing the asset of the corporation, which is very essential to accumulating or maintaining the wealth of its shareholders in the long run. Ericsson has market capitalization of 31.74 billion. It has a high PE ratio of TTM of 1.32 and 17 compared to Qualcomm's 24.67, while Cisco has 19.03. It shows that maybe the share of Ericsson is overvalued as its PE ratio is extremely high against its competitors. PEG ratio of Ericsson is 0.79 with forward price earning ratio of 15.77, which suggests that as of now, this stock is undervalued actually. Hence, it's just a matter of time that share price of this stock shall be relatively priced at Qualcomm or Cisco's level. So where does the sales growth expectation of Ericsson come from? Let us look at their 2019 annual report highlights and relative research. It is notable by year-end 2019, Ericsson has expanded its network business. It has announced 78 commercial 5G agreements with individual operators and 24 live 5G networks across the globe. Meanwhile, its digital services, the business momentum in the new portfolio of 5G and cloud-native product is good. It grew by 7%, driven by customers' investment in 4G and 5G. In year-end of 2019, 71% of those critical and non-strategic contracts identified in 2017 has been addressed. Meanwhile, its managed services, R&D investment is increased in 2019, and in first quarter, a new artificial intelligence-based offering for operators, Ericsson Operations Engine, was launched. So we expect that it could give them a great revenue come 2020 and the years ahead. Also, they have emerged business and others in 2019 in which they had made a significant investment within IoT or Internet of Things, which actually drive the growing demand of 5G opportunities around the globe. They have a key announcement. Ericsson and Swisscom had launched the first large-scale commercial 5G networks in Europe. Ericsson also built a new state-of-the-art 5G smart factory in Texas to meet the demand for rapid 5G deployments in North America. So again, we can expect a large volume of sales coming in the years ahead starting 2020. They also acquired current antennas and filter business, which will enable them to broaden their portfolio of antenna and filter products. They also have reached resolutions with US FCPA investigation and had announced that the resolution of the previously disclosed investigations by the U.S. Department of Justice and the Securities and Exchange Commission regarding the compliance with Foreign Corrupt Practices Act or FCPA. So what makes the global 5G services market interesting? Grandview Research, according to them, that the 5G service market is estimated to reach $41.48 billion by 2020 and expand at compound annual growth rate of 43.9% from 2021 to 2027. 5G wireless mobile services are expected to commercialize in 2020. As a result, this evolution opened an opportunity to each business expanding their sales growth to higher level. However, before it can be implemented, this industry needs an infrastructure which, according to Gartner Incorporated, infrastructure revenue would reach to $4.2 billion in 2020. That is an 89% increase from 2019 revenue of $2.2 billion. Global data said that Huawei is the leader in industry across all evaluated criteria as CSP. Second in position is Ericsson based on mobile core contracts, CIDI model, and standards leadership, followed by CTE and Cisco. However, as United States banned its number one competitor Huawei, it gives significant competitive advantage in favor to Ericsson, as Nokia was late to develop the comparable product that Ericsson developed, which Huawei can't able to because of the renewed trade tension. Accordingly, North America is expected to dominate the 5G services market with a share of 34.3% in 2020. Though, according to Morningstar analysts, they won't change their fair value estimates as they think that the ban is temporary. Though they had acknowledged that Ericsson and Nokia have lots to gain as telecoms can't wait further as they had evaluated their 5G rollout. However, in June 2, 2020, the complete turnaround has begun when Ericsson earned the contract of leading Canadian telecoms, Bell Canada and Telus, strengthening Ericsson's core in the regions, joining with Rogers Communication, which has been Ericsson's partner since 1985. The ban of Huawei in the United States gave Ericsson a competitive advantage to dominate the infrastructure industry. Imagine getting a proportionate share of the 30% on North America's 45% market. Would mean Ericsson could potentially have additional market share of 16%, rounding its market share to potentially reach at 41%. So with the new contracts, currently, Ericsson has 40 live 5G networks in 22 countries. It currently has 93 commercial 5G agreements with unique operators, 51 publicly announced contracts, including the newly entered Canadian market, the True Corporation in Thailand, 20 known contracts in Europe, Middle East Mobility, STC Batelco, among others. In addition, Ericsson earns a deal with China Mobile, China Telecom, and China Unicom as co-vendor with China's very own Huawei. Meanwhile, Yahoo Finance projected Ericsson's growth rate in the next 5 years to be more than 25%, which is pretty valuable to investors who's looking for a growth stock. Moreover, Ericsson had increased its share price by 10% in the last 3 months despite of the industry's decline of 2.8%. Ericsson may take it slow, but one thing for sure that it will continue to innovate, would strive to build a stronger company in the long term with the guidance of its CEO, Eric, who is an independent director of various companies including Alibaba. At age of 56, he can drive Ericsson to its new flights as he restructured the company years ago. My key takeaway here is that Ericsson's share is one of the best growth stocks to buy as early as now. We don't have to wait until this one would become at 20 or 15 or at $40. It's better to buy at a cheaper price. Although I'm not encouraging you to follow my advice, to follow my guidance, because we all know the stock market is very volatile. Anything could happen. You have to do your own research, do your own fundamental analysis. In my own point of view, in this type of stocks, I would have to hold it long term for at least 5 to 10 years. So that's all for now, guys. Just remember that the best time to start investing is now. Always remember that you have to be money-minded, not only now, but also in the future. See you next time. Please don't forget to hit that subscribe button and that notification bell so that you won't miss my succeeding videos. Bye-bye!